In this next section, I'm going to review the euro dollar, and the euro dollar has resistance at 109.80 to 90, and I see a target in this market at 105.90 and below. So if the price gets to 109.80, that's going to be a great opportunity to trade this market. So let's review the euro dollar chart and see what this market is actually doing. As you remember from the analysis that I've been doing the last 3 years on FX Street, this market has a resistance around 139.60, had a resistance which broke price into the first target, and then it started a lateral move that lasted basically 1.5 years here. It's pretty long. So this market really was not really interesting for trading. Now what's happening now, one of the developments that we saw last week is this break last week, which confirmed the potential for this price to revisit again lower prices here, 105.90, 105.50. The point is, this might not happen right away and on a straight line. And giving you here the key and the levels that I believe should be watched. If this market gets back into previous lows here, and these are out of participation from Algos, as I mentioned before, 109.80 to 109.90, then we could get some participation. And remember, this is also a bear dumb money area, so there'll be a lot of non-professionals and professionals alike actually trading and shorting this market. So when we have smart money and dumb money trading together, we know we can have very good results. So if this market continues higher and meet this area, that's going to be a great shorting opportunity for the euro. If that does not happen, I would not risk anything here. There's no reason to risk anything. I always want to see the right and low risk, high probability setup taking place. Otherwise, I'm not in the trade. I'm not interested. Okay, so that's my suggestion there. This is basically the analysis for the euro dollar. Where we see the euro dollar, well, we see it into this first target eventually, 107. It's 107, 108, and then eventually 106.90 in its way into previous lows. Okay,